Welcome back, students who are taking financial accounting, and this is the last video in the series of videos that we were working on the assigned homework problems for Chapter 5, the problems for Group B. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help you if you don't understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get that understanding. All right, so problem 5-55. It says here, Keystone Electronics has the following information for the years ending January 2013, 2014. Number one, it says compute the rate of inventory turnover for Keystone Electronics for the years ending 2013, 2014. Round the result to 2 decimal places. Then we're going to calculate the days sales in inventory for both years. And then 3 is what is the likely cause for the change of the rate of inventory turnover from 213 to 214. All right, so for inventory turnover, the formula was, cost of goods sold over the average inventory, and average inventory. And remember that the average inventory is the beginning inventory plus the ending inventory divided by 2. Okay, so we'll do 2013 first. Right, now I'm going to write this stuff down, so when it's down, pause the video, copy it down if you need to, because I'm going to erase it. I'm going to work on this same slide instead of bouncing back and forth. Okay, so for 2013, we have to look at our beginning inventory, which, our cost of goods sold is 151,000. And our average inventory is the beginning inventory of 28,000 plus the ending inventory of 24,000. So here's the 151, here's the 28, and here's the 24. And remember that this 28 plus 24, add those together and divide by 2, so you get 151 over, let's see here, that's 52,000, and that's divided by 2, or 26,000. So it's over 26,000. So 151,000 divided by 26,000 gives us 5.81 times per year. Okay, so the answer is for 2013, the inventory turnover, let me write that up here, is 5.81. Actually, let me write that in black so you can see it a little bit better. 2013 is 5.81. Okay, so pause the video because I'm going to erase this. Okay, so for 2014, we're doing the same thing. Okay, we have 153,000, and that's over 24,000 plus 18, which is divided by 2. So that's 153,000, and 24 and 18 is 42. 42 divided by 2 is 21,000, and that gives us 7.29 times per year. So for 2014, our inventory turnover is 7.29 times per year. Right, so go ahead and pause the video, and I will work on the day sale in inventory. Right, so I'm erasing all of this. Now, remember the formula for day sale inventory is the average inventory, over the cost of goods sold, which is then divided by 365. Okay, so now I realize that I could have kept the information from working through the inventory turnover on the screen, right? But it does help a little bit to go back through this. Remember, average inventory is beginning plus ending divided by 2, right? And now that, we're instead of having the cost of goods sold in the numerator, now it's in the denominator, and we're dividing it by 365. So we're basically, for inventory turnover, we're trying to figure out how often we turn the inventory over during the course of the year. But by taking and putting the average inventory in the numerator and the cost of goods sold in the denominator and dividing it by 365, that gives us our days sale in inventory. All right. Try to fix that relationship in your mind, and it'll help you remember that a little bit better. So for 2013, we have to get our average inventory, which is the 28,000 plus the 24,000, and that's all divided by 2. And of course, this all goes over the cost of goods sold, which is 151,000, and that's divided by 365. So you have a calculation you have to do in the numerator, and you have a calculation that you have to do in the denominator before you can actually figure out the day sales. So again, 28,000 plus 24 is 52 divided by 2. So that's 26,000 is our average inventory. And if we take the 151,000 and divide that by 365, we get 413.70. I rounded to the 2 places. And if we divide the 26,000 by the 413.70, we end up with 62.8 days of days sales in inventory. All right. So for 2013, that's 62.8. Okay, pause the video. I'm going to erase this. Okay, and now we're coming back, and let's do 2014. Same way, we start out with 24,000 plus 18,000, and that's divided by 2 because that is our average inventory. And then we're going to divide whatever that is by the cost of goods sold, which is 153, and that the cost of goods sold is divided by 365. Okay, so we have to do again the 2 calculations. So 24 and 18 is 42 divided by 2 is 21,000, and 153,000 divided by 365 is 419.18, and I round it to the 1/8. And then when I divide 21,000 by that 419.18, I end up with 50.1 days. Okay, so that's 50.1 days. All right. Okay, so now on number 3, what is likely cause for the change in the rate of inventory turnover from 2014 from 2013 to 2014. So it's asking about why did our inventory turnover change from 581 to 729. Okay. If you notice, the cost of goods sold stayed relatively constant. I mean, we're only talking about from year to year. Okay, before I go there, when you're looking at inventory turnover, you're only looking at basically two different things. You're looking at inventory, all right? So we're talking about the change in the inventory, and we're talking about the change in our cost of goods sold, right? So if we look at the cost of goods sold, we notice that that stays pretty much the same. I mean, it's only, the difference in the cost of goods sold from year to year is only $2,000, and as a percentage of 150,000, let's see here, divided by 2,000 divided by 150, you're only talking about a 1% around approximate 1% difference. Okay, so the difference for the change, if we look at the change in inventory, right? For 2014 that was 21,000, and if you'll recall, the change for in inventory for 2013 was 26,000. So that's a $5,000 difference there. Okay, and $5,000 difference on approximately 25,000 is about a 20% difference. Okay, so even though the numbers look relatively close together, meaning when you're looking at, when you're trying to figure this out, you're saying, oh, well, if I have the difference between 153 and 151, which is 2,000, and you kind of like say, okay, the difference between 26,000 for 2013 on the inventory and 21,000 for 2014, you say that's only like, oh, that's only about 5,000. It doesn't seem like much, okay, because you're talking about 5,000 versus 2,000. It really doesn't seem like much, but it's not the absolute value, it's the relative value that makes the difference. Okay, absolute being the 5,000 versus the 2,000. The relative value is, yeah, it's 2,000 on 153,000 on approximately 150,000, and it's 5,000 on approximately 25. The percentage here, when you're looking at your cost of goods sold, is 1%. But when you're looking at the percentage on your inventory, you're talking about 20%, which is a huge difference. So the likely cause of the change in the rate of inventory turnover is because of the difference in the inventory, okay, and not because of the change in the cost of goods sold. Okay, so yeah, you can read the answer and see what that says, but when you're if you rewatch this portion of the video on that explanation, you'll see that goes into much more detail. And when you're looking at these as an overall thing, when you're looking at these ratios, it's one thing to memorize the formula and to plug the numbers in, okay? But if you don't think through what the numbers are telling you, it doesn't, it doesn't matter, right? You just have no concept or no clue, all right? You have to be able to see in terms of absolute versus relative, think through, what is being used in that formula, and see the relationships that are involved in that formula. Now, yeah, when I'm, it's asking us what the likely change between the 2 years, between 2013 and 2014. I mean, obviously, we turned our inventory over, 7 times, well, 7.25 versus almost 6, 5 3/4 between 2014 and 2013, in those years. And, that's good because, on the surface, yeah, we're turning our, it's good that, we're moving our inventory more this year than we did last year. However, what was the underlying reason for that? If you don't understand the underlying reason, then you don't know, going forward to next year, how do you know what to concentrate on and what to make changes to? Our cost of goods sold stayed pretty much the same. And if you look at our sales, that stayed pretty much the same. I mean, we're only talking about $8,000 difference between the 2 years. So it really wasn't the price of our goods that, whether that was going up or down, or were we selling more or less. That all kind of stayed the same. But what made a big difference is what we were doing with our inventory. So I hope that helps, and I hope that gives a little bit more insight as to how to think through what these actual ratios and formulas mean. I mean, like I said, each chapter you're going to have a section, focus on decision making. You had that if you had math for business and finance, you had a whole chapter on these ratios, but you really didn't work through and think through what you were doing then. It was just plug and play the numbers. Well, now as you're going through the financial accounting textbook, you're revisiting a lot of these here ratios, and you're expected to get a little bit more in-depth understanding. And for those that are going to go on, that are accountants and are going to go on in the curriculum, you're going to see this again in intermediate accounting, and it's going to be even more in-depth. So start building that understanding. Right. So that's it for the chapter 5, and we'll see you all for chapter 6.